Welcome back, learners, to the course on Essentials of Financial Management, lecture number 4, Financial Planning. If you recall the previous lecture, that is lecture number 3, we discussed about the financial decisions, which includes investment decisions, financing decisions, and dividend decisions. In this lecture 4, we are going to discuss about risk-return trade-off in financial decisions, financial planning, characteristics of a sound financial plan, and limitations of financial planning. So let's begin. Financial decisions and risk-return trade-off. This is a part of the previous lecture where we are discussing about the financial decisions. So what are the risk-return trade-off as far as the financial decisions are concerned? So whenever an organization takes any financial decisions, it has to make various risk-return trade-offs. Let's say because it involves alternative course of action. Financial decisions involves alternative course of action, and different alternative course of actions imply different risk-return relationships. Alternative course of action, and they imply different risk-return relationships. So let's take an example. Let's say an organization wants to purchase a equipment which has a manufacturing capacity of 50,000 units, right? Or let's say this is option A and let's say option B is it wants to purchase a equipment which has a manufacturing capacity of 2 lakhs units. Okay. Or let's take another example. Let's say organization wants to decide whether it wants to have a debt equity ratio of 1:1 or 3:1. These are the different course of actions. Or let's say take another example. Organization wants to decide how much money it wants to retain and how much money it has to pay in the form of dividends. So all three decisions that we discussed, the one regarding the equipment purchase was related to investment decisions. The one related to the debt equity ratio was related to the financing decisions, and the one related to the how much you want to retain and how much you want to pay back was related to dividend decision. These all decisions carry different amount of risk. Let's say if you want to purchase a machinery which has a capacity of manufacturing 50,000 units, you are taking less risk as far as the cost of investment is concerned. But your return will also be less because capacity of that machinery is less. If you want to make an investment in a machinery which has a capacity of making 2 lakh units, the risk of investment is more, but expected return is also more. So these are the risk-return trade-offs. Let's now talk about the debt equity ratio. If a firm has a debt equity ratio of 1:1, it is a conservative kind of capital structure where company is not taking that much of debt. So in that case, the risk of liquidation or the financial risk to the company is also less because payment of interest is a legal obligation for a company, right? Or if a company is taking a debt equity ratio of 3:1, is having a debt equity ratio of 3:1, it is having a substantial amount of debt. In that case, the risk of liquidation increases because even if the company is not making that much of return, it has to pay interest on the debentures that they have issued. So in that case, the risk of liquidation increases. So that is the risk-return trade-off. Obviously, debt is a cheaper source of funding, but more of debt can lead to liquidation also. And if a company is paying more dividends, so it is left little with to make some future investments. If a company is paying less dividend, then the shareholders might not be that much happy. So again, compromise between those two decisions. So these are the risk-return trade-offs. So financial decisions, when we talk about financial decisions, they are the investment, financing, and dividend. They involve balancing risk and return. We've already seen through examples, right? Every decision has the potential to increase returns, but also comes with a certain level of risk, right? So we saw in case of investment decisions also, financing decisions also, and dividend decisions also, that each decision, each alternative course of action has the potential to increase the returns, but at the same time, increase in returns comes with taking more of risk. So if you see this figure, you see we have investment decisions, which is segregated into capital budgeting and working capital management. We have financing decisions, which is all about capital structure decisions, the proportion of debt and equity. And we have dividend decisions, how much we should retain and how much we should pay. So taking the alternative course of action, we have different risk and return with all these decisions. We've already discussed this with example. And when we have different risk and return, they lead to the market value of the firm, right? Now we have some examples to clarify the relationship between financial decisions, risk and return trade-off, and the market value of the firm. So first, let's start with the first is investing in a new technology. It is a investment decision. When you invest in new technology, obviously a substantial amount of funding is required, right? So it is a kind of investment decisions. So what it is, a company decides to invest heavily in developing a new and innovative technology, right? So what are the risk and return trade-off in this case? High risk, high return decision. Investment in technology requires a lot of capital outlay. So it is a high risk and high return because companies deploying a lot of capital in that and with her expectation that it will generate a higher return on that, right? So technology could be a breakthrough leading to significant profits and market share. So one of the outcomes could be technology could give a leverage to the company. It can be a breakthrough. In that case, it would give a competitive advantage to the company. So that is one thing. Or what is the other probability? It is not sure that the technology will work all the time. So a higher failure rate is also possible. So technology could also fail, resulting in substantial losses because a lot of capital is already put into the research and development or getting that technology. So in case that fails, so company will suffer huge losses. So that is the risk with this. So what impact this might have on the market value? If investors believe the technology has a high chance of success, the company's stock price might increase. So if the investors have a perception that the investment that the company is making in developing they have the perception that technology will work, right? So in that case, the stock prices might go up. On the contrary, if investors have a perception or they are skeptical that the technology might not work or the failure chances of the company are more, in that case, the stock prices might go down as well. So this is the impact on the market value. Now let's understand the same thing with another example, which is funding and expansion, which is a financing decision. So this is a second kind of decision. So when you are funding expansion, a company decides to finance expansion by issuing debentures. So there are multiple options as far as the funding is concerned. Company can use equity, company can use debentures, company can use preference shares also. But here let's say company decides to use debentures. Debentures are a cheaper source of funding, right? But the risk is also more in the debentures. So what is the risk return trade-off? Debt financing can be cheaper, but it also increases the company's financials because payment of interest is a legal obligation, and irrespective of the fact whether the company is making profit or not making profit in the lean years, company is bound, legally obliged to pay the interest regularly. So that is the financial risk, and inability to do so will lead to the risk of liquidation. If a company is unable to generate enough cash flow to repay the debt, it could face financial distress, which can get converted into bankruptcy and liquidation, right? Now, what impact it has on the market value of the firm? If investors believe the company can successfully manage the debt and generate higher profits, the stock price might increase. So if the investors trust the company that the company has the ability to manage the substantial amount of debt in profitable revenues and generate sufficient returns and make regular interest payments, the stock prices will go up, right? But it is not always the same case. If investors are concerned about the company's ability to repay the debt, in that case, what will happen? The stock prices could go down. So investors might also have the perception because more of debt will increase the financial risk. So if investors perceive a lot of financial risk, or the investors perceive that the company might not be able to repay the debt in a fair way, So in that case, the stock prices might also go down. Now let's talk about the third example, where we are talking about the risk return relationship in case of a dividend decisions. Now this is related to dividend policy of an organization. So what is the decision? A company decides to increase its dividend payout ratio. Now company makes profit and it has decided that it will increase the proportion of the dividends that it is paying to its shareholders. Now this is the decision they have taken. Now what is the risk return trade-off here? Less cash for reinvestment and could limit future growth. If a company is paying a lot of dividends to its existing shareholders, what will happen? Shareholders will be happy because they are getting a lot of dividend, substantial amount of dividend. But on the other hand, the company is not getting sufficient fund remaining after the payment of dividends. And in case the company has liquidative investment opportunities, it will find it harder to make investments there. So it is compromising its investment opportunities. These dividends provide direct return to shareholders and can be attractive to some investors. So from investors' point of view, it is good because they are getting dividends. Now what impact it will have on the market value of the firm? If investors value current income over future growth, stock prices might increase. So there might be a certain class of investors who are looking for regular dividends as a source of income. So they might be happy. So if that class is more, then stock prices might go up because they are meeting their objectives. The company is paying handsome dividends. On the other hand, there might be some investors who are more focused on long-term growth. This is the keyword, long-term growth. Stock prices might remain unchanged or even decrease slightly. Those investors, if there are a lot of investors who value long-term growth of a company, right? So they are more bothered about the inability of the company to make investment in good projects because they don't have sufficient retained earnings with them. In that case, the stock prices might remain unchanged or it might slightly go down also. So if we conclude this, that is the risk return trade-off of the various decisions. So we can say that a financial manager has to strike a balance between various sources so that the overall profitability of the firm and its market value increases. So we already discussed that there are various courses of actions, different alternatives. So a finance manager has to strike a balance between various courses of action. And the ultimate aim is to increase the profitability of the firm and the market value of the firm, right? Now there are three basic questions which a finance manager should ask himself before taking any financial decision. So what are those three questions? The first one is, what is the expected return? If you're taking any financial decision, if you're making any investment, the first question that you should ask yourself is, what is the expected return associated with this particular investment? Next question is, what is the risk involved? What amount of risk am I undertaking? Am I taking more risk for the amount of return that I'm expecting? That is the second question that he should ask. He should not take substantial amount of risk. Third is, what would be the decision influence on the market value of the firm? Whatever decision I have taken, whether it's an investment decision, whether it's a financing decision, whether it's a dividend decision, what impact this decision is going to have on the market value of the firm? If you evaluate these questions rationally, then I think most of the financial decisions will be good. Okay. So next topic is financial planning. So what is planning is very important to achieve your objectives. If you want to achieve anything, I'm not only talking only in context of the financial matters, but anything in life, you need to make a plan to attain your objectives. If your planning is good, it will facilitate you to attain your objectives. So what is financial planning? The application of planning to finance function. So application of planning to the finance function is what financial planning is. Economical procurement and profitable use of funds. So it should facilitate in finding out the cheaper source of funding and its proper utilization, right? You should look for those sources of funds which are cheap or a mix of those sources which minimizes the overall cost of capital, and then rationally allocate those funding in profitable investments. Formulated in the light of present as well as future developments. It's not only about thinking of or planning of the present scenario, what are your present needs, but it should be a long-term thing. What would be the need of the company in terms of financing after 1 year, after 5 years? So all these things should be taken into consideration. What are the probable market opportunities that the company might like to tap in? So all these things should be taken into consideration while making a financial plan for an organization. Statement estimating the amount of capital and determining its composition. So how much capital is required and what should be the composition, or what should be the proportion? How much should we raise from debentures? How much should we raise through equity? How much should we raise through bank loans? How much should we raise through preference shares? All these things should be clearly stated. Financial planning is like creating a roadmap for resource allocation and financial decision making. So whenever you want to reach a target, you need a map. So financial planning is like that roadmap, which will help you in reaching that destination, in attaining your objectives. Now, according to Cohen and Robbins, what financial planning is? It should determine the financial resources required to keep a business running smoothly, right? Forecast the extent to which these requirements will be met by internal generation of funds and extent to which it will be met by external sources. So, you know, the company retains profits year after year, and these are the internally generated funds. So, once company has decided that this much funding would be required to make some investments, it should decide how much should be the external, how much should be raised to external sources and how much internally generated funds should be used. That should be clearly known. Develop the best plans to obtain the required external funds. Internal funds are fine, but all the funding requirements cannot be met by internally generated funds. The company has to go for some external funds also, either from banks, either from issuing equity or debenture. Analyze the financial results. So once you have made a plan, you also need to analyze the results, whether the company is going on the right track. What is the return on investments? Whether it is in line with what the company was expecting, right? Report facts to the top management and make recommendations on the future course of action. And whatever the results are, you need to report to the top management and give suggestions that these are the corrective measures which could be taken. Okay, then let's continue with the financial planning. Some examples of financial planning. A startup company seeking funding. Now, when a startup company is there, what it will be doing? It will make a detailed financial projections, explanation of business model, and how they would use to the funds for growth. So, a startup company which is seeking a funding, they should first need to prepare a detailed financial projections of the next few years, right? This much be the financial projections over the coming years. Then they should be able to explain their business model to the funding agencies. And finally, they should be able to justify how the funds they are trying to raise, and they would be projecting or using it for the growth of the organizations. Like, I think you must have seen the show Shark Tanks. What the people do? They try to project all these things and try to get funding, right? A manufacturing company investing in equipment. So, manufacturing company first needs to do a cost benefit analysis. So, what is cost benefit analysis? If I purchase this equipment for manufacturing something, what is the associated cost? Let's say a shirt manufacturing company purchases a manufacturing machine for making shirts, and it comes at, let's say, 10 lakhs. This is the cost. What benefit the company is going to get? How the revenues would increase? How the production capacity would increase? This is the cost benefit analysis. Next is planning for financing purchase. Now, that equipment or that machinery is worth 10 lakhs. How that will be financed? Whether the retained earnings would be used, whether the company would take a loan to finance it. So that should be decided. And finally, the profitability projections, the purchase or the usage of that machinery, what impact it is going to have on the profitability of the company, that should be clearly stated. A retail company expanding into the new market. So there's a retail company and it wants to explore a new territory. So first of all, it needs to prepare budgets for market research, because when are you entering a new market, you need to do a market survey, try to understand the needs of the customers, what products have worked, what products have failed. A proper thorough market research is required. It also needs to make investments in market campaigns, just to make people familiar with the products that the company is about to offer to the market. So market campaigning is required. New store opening, that also requires financing. So all these things should be planned. Now, what are the benefits of financial planning for any organization? There are several benefits. So let us look at one by one. Achieving strategic goals. So when we talk about strategic goals, it's the long-term goals. Financial planning will help you in attain the long-term goals of the organization, whatever that goals may be. Some might be trying to increase their profitability, whatever the goals are. Make informed decisions. Next is, now informed decisions is financial planning facilitates you with various information and you are able to take calculated risk, you are able to take good financing decision, investment decision, dividend decisions. Improve financial performance. Financial performance like you can see an increase in return on investment, and if you see an increase in your liquidity ratios, you see an increase in your profitability ratios or turnover ratios. A proper financial planning can help you in attaining these matrices or surpassing the standards that you have set for your organization. Attract investment. If a firm constantly makes good financial planning, then it will have a healthy financial structure and it will help in getting the investors. So people will be happy, they will be willing to make investment in that company which has made sound financial plans and following those plans. Ensure sustainability. Sustainability means long-term existence. A company which is well prepared, which is following a good financial plan, would be able to meet the ups and downs of the market and keep continuing to work over a longer period of time. Characteristics of a sound financial plan. What are the characteristics of a good plan? First is adequate funds. It should ensure that an organization has sufficient amount of funds. Neither it has shortage of funds, neither it has too much of funds which it finds it difficult to employ profitably. That's the first thing. Balancing the cost and risk. So here it is talking about taking moderate level of debt. Obviously, we know that debt is a cheaper source of funding and organizations want to use more debt to minimize their cost of borrowing. But more of debt could lead to higher chances of financial risk also. So companies should try to make a balance between cost and risk. Simplicity, that is avoid usage of too many securities in capital structure. Whenever a company is thinking of raising funds, it has multiple options through equity, preference shares, bonds, debentures, bank loans. But if you use too many of securities, it makes the capital structure very complicated. So because you need to analyze the risk return associated with every decision, so using multiple securities or too many kind of securities makes the capital structure complicated, and the organization should not make the capital structure complicated. Long-term view, need for funds in near future and over the longer period. So financial plan should not only focus on the current position or current situation of the organization, but it should also focus on the future prospects. What are the future needs? So company should plan proactively, anticipate the financing needs over a longer period of time. Liquidity. A financial plan should ensure that the company has sufficient liquid funds with them, because during recession, depression, the liquidity is what it matters. Whatever, let's say, assets you have, some assets should be in a way which could be easily converted into cash when required. Let's say from an individual's perspective, if you have a lot of money and you have put all the money in purchasing land or let's say your real estate, so you need cash. It's very difficult to convert them into cash quickly when you need. So as an individual, you should put some money in those kind of assets where we can convert it into cash quickly, such as mutual funds, right? Economy. Cost of raising funds should be minimum. So the company should look for those avenues which minimizes the overall cost of capital. Because if the cost is low, then only you can have your profitability reach a higher point. Flexible and adaptable. The environment is changing, so the plan can be adjusted to respond to the changes in business environment. If you are not able to adapt to the changing circumstances, it becomes difficult to sustain. like contingency plan. You should always have a backup plan. Let's say if your revenue starts declining, so how you can control or minimize your expenses in that case? That is the contingency plan, the backup plan, or the plan dependent on the situations. Limitations of financial planning. Now, financial planning is not without limitations. There are few drawbacks or limitations. Let's discuss. Uncertainty and unpredictability. Now, future is uncertain. We cannot predict what will happen tomorrow. So, this plan makes an assumption about the future, maybe 5 years down the line, 10 years down the line. So, that element of uncertainty and unpredictability makes financial planning more difficult. Inaccurate forecasting. Sometimes companies might overestimate the demand, and in that so in that case, the plan that you have made will not work, right? Rigidity and inflexibility. Plan should not be rigid. It should be flexible, because if a plan is very rigid, if any opportunity comes into picture, the company will not be able to tap it. Let's say there is an opportunity where company needs to invest, and the company has decided the investment ceiling up to a point, so it will not be able to tap those opportunities. So plan should be not that rigid, and it should be in such a way that it should be able to tap the available opportunities. Conflict of interest. Now, different stakeholders might have different interests. Let's say maybe investors are looking for regular income, the company is looking for, let's say, retaining the profits for future investments. So in that case, the conflict of interest might be there, and the financial planning might not be that much effective. Lack of implementation. One thing is planning and other thing is executing. So if you have made the plan, that is fine. But if you are not able to implement it or execute it in an efficient manner, then the plan will not work properly. So the company should ensure that the plan is also executed properly. Overemphasis on financial data. So mostly when companies make financial plans, they overemphasize on quantitative data, right? The balance sheet figures, profits, and all those things. But sometimes they overlook or neglect the qualitative factors also. But it should be acknowledged that qualitative factors also matter, like the level of customer satisfaction. That is an important qualitative factor. The kind of services, these all qualitative factors should be taken, or the brand image of the company, that is again a qualitative factor. These factors also have an impact on the overall profitability of the company. So company should not neglect these qualitative factors apart from the quantitative factors that the company has taken. Problem of coordination. Now, organization consists of several departments. Finance department is one, but apart from that, you have the marketing department, you have the HR department, you have the productions department. And when you want to make financial plan, you need to take suggestions for all these departments to know about the requirements of funding from these departments. Until and unless all the departments have a proper coordination, they are on the same page, you cannot have a comprehensive financial plan. And sometimes you will see that there is not a proper coordination between these departments in an organization, which creates a problem in forming a financial plan. And finally, the rapid changes, fast changing situations, marketing channels, consumer preferences, and technology. Because of the technology, because of the changes in consumer taste and preferences, the products needs to be updated. If a company is very rigid about a particular product line and they are emphasizing that they will only be staying with this product line, company will fail to expand, or the company will fail to grow. So company should make sure that it takes into consideration the impact of technology, the changes in customer taste and preferences, and plan accordingly. So these are the further readings which you can go through to have a better understanding of the contents that we have discussed. Thank you so much.